Hi, this video will be addressing question O of the FINS3635 assignment, where our group will be having a look at the simulator for the lesson Acuna 2301. So at the beginning of our simulation, the simulator is going to start making some automatic trades, selling a few cores. So what we need to do first is keep an eye on our delta. We need to buy some futures to keep our delta close to 0. Next we're going to buy the put strangle combination to balance out our vega. Our goal going forward in this simulation is to try to stay risk averse by buying and selling options of similar strike prices. Now there's an opportunity to purchase this 300 put option, and although it has a pretty decent edge, we decided as a group not to go for this option. Instead, we tried to neutralize our trade position at the money strike price, and so here we're lowering our volatility to try and sell more cores at the money strike price. However, this didn't really work too well, so our team had to rethink our strategy. We tried increasing our volatility at the 0.02 delta in an attempt to buy some cores to neutralize our upside trade position, but this didn't work either. Instead, we just decided to sell some of our combination options to expand our inventory. Our plan to stay risk averse wasn't working too well. In hindsight, we probably should have bought more combinations to get more of an edge. At this point, our vega is looking a little high in its value, so we're going to try to buy back some of our options to make it go the other way. We're also quite short on options near our at the money strike price, so buying options is also going to help us neutralize our trade position at the money strike price. Okay, now that we've neutralized our vega position, we're going to be trying to buy options at our upside, so near the 0.02 delta mark, so that we can try and neutralize our trade position, since we're short minus 25 right now at the 500 strike price. Once again, we're going to try and attempt to raise the volatility at the 0.02 delta mark so we can purchase cores near this strike price. And there it is, the opportunity arises, so we can now purchase the 510 core option, and we now have neutralized our trading position at this point. And just going to hit that reset quote button to send our quotes back into the market. Next, we're going to have a look at our downside. We're lowering the volatility at the 0.9 delta mark in an attempt to neutralize the long 25 position we have at 330 strike. In hindsight, we think it was a bad idea to short the exact same strike price and cancel out our position altogether. We feel as if this has had a detrimental effect on our inventory. And just there a bit earlier, we bought and sold a core at near the same strike price to grab a bit of profit with not too much risk. And here now, towards the end of our simulation, we're thinking of better neutralizing our trade position at the upside. So we're lowering our volatilities to short some of our product. However, just a bit later, we realized looking at the numbers that shorting would be in the wrong direction. To better neutralize our trade position at the upside, we should have been going long on these cores, so we tried to start raising the volatility at the end here, but it's a little too late and we can't really fix that. Last 10-second warnings of the simulation pops up. We're still trying to increase that volatility, but it's not really working out for us. Now let's have a look at our risk matrix here at the end of the simulation. So our Greek letters are in a pretty good position. The delta, as you can see, is very well neutralized, and even with large up or down swings in our futures price, our vega, theta and gamma are still going to be quite low. Our final profit is 1,324 and is even better with an upswing in the underlying. However, the P&L is abysmal at downswings in prices, and this is due to the lack of downside protection in our trade position. We're severely lacking in puts, and this is going to be a huge risk for us if the future price goes down. In our inventory, we have a short straddle at the strike, which will cause huge loss if the price deviates too much from the strike price, and this means our overall profit is capped by the option premium, but our loss is unlimited.